Hello, this is Edward with nonaccountant.com and welcome back. Today we're going to learn about three key metrics that you can use to simplify your business life. And a lot of times I talk to entrepreneurs and new small business owners. They get confused because they don't know what numbers to look at, or they're just so overwhelmed with financial information. They just don't know what to track, or they're tracking too many things, or they have all these spreadsheets tracking just numbers, numbers, numbers. So what I want to do is share three key metrics that you can track starting off, and you can always grow, but at least three things that you should be tracking and should be aware of in your business. So first one, customer acquisition costs. We're gonna then talk about the gross profit, and then we're gonna break down the break-even point, and more specifically, the break-even unit point. So or break-even unit sale. So understanding how many units you need to sell in order to break even. So we're going to start off with CAC. That's the acronym for customer acquisition cost. And this is basically how much are you investing to acquire a new client. That's all this is. So this is very key because if you're putting too much money into marketing and it's not giving you a return, that means that, okay, we need to change our strategy. So and it also helps you see how much you need to price or charge a customer as well, because if your marketing cost is too high and then you're not charging as much, it's going to take way more customers, or a lot of customers, to break even just on the marketing side. And we haven't even touched the remaining expenses your business is going to have. So these three metrics I will share with you, they all kind of bleed together. They all kind of work together, from the customer acquisition to the gross profit margins to your break even. They all flow together. So whether you're doing marketing online, whether that's Facebook, Google, offline, whether that's direct mail, postcards, what have you, you need to track that. Track it. So these are the things we need to use to figure this out. So it's basically your marketing dollars divided by your customers acquired. And we're going to put in some simple numbers. So let's say we invest $100 into marketing, and then out of that marketing, we gain two customers. So our customer acquisition cost was $50. So in other words, we invested $100, we got two clients, and that is like saying we spent $50 per client. So 50 times 2, that equates to our $100. So in this example, it took us, it cost us $50 to get one client, and we got a total of 2. So you can go deeper with this. This is very simple. There's other costs you can look at, and also when it comes to the customer acquisition, you may want to look at the total amount of customers that you have targeted, and then what converted over. Because let's say if out of those two customers, let's say if we marketed toward 50. So that's where we would look at conversion ratios. But on a very simple note, at least understanding how much does it cost to acquire a customer or a client, that's the starting point. So now we'll move over to gross profit. This is a very cool and a very important formula as well. It shows you how efficient are you running, how efficient are you operating. So it's basically your sales minus any direct cost. So whatever you charge minus the direct expense to create that sale. And this is a lot simpler when you're dealing with a retail type business. Let's say if you're selling something for $10, but it costs you $5. That's the cost of that inventory. So what you would do is take 10 minus the 5. So the amount of money you're selling it for, 10 minus 5. That's what you bought it for. That's going to give you a gross profit of $5. So if you're doing a service-based business, whoever is providing that employee cost of that person that's providing the direct labor, that would go in that category. So just to put some numbers in, so if you have a sale of $10, but that costs you $5 to buy or manufacture or what have you, That's going to give you a gross profit of 5. So that's a gross profit of 50%. And next, what we're going to look at, are you making enough to cover your overhead? And this is your break-even point. So are you making enough to cover overhead? And think about how important this is, because you can have low customer acquisition costs. You can have a strong margin, gross profit margin, but you have remaining fixed expenses. So if your gross profit margin isn't high enough, then you could still be losing money because you're not bringing enough money in from your core business. So this is how we're going to figure this out. And your fixed costs can be things like rent, utilities, telephone. These things, keep in mind, will never, of course, the amount may change, but pretty much you will have to pay these things regardless of if you make a sale or not. So that's why when it comes to bookkeeping, you want to spend the time to get your fixed costs and your other like variable costs separated or in the right category. So you want to be able to see what is your overhead, that is the things you're going to have to pay regardless of if you make money or not. You still have to pay. Just think about if you rent an office, your landlord isn't going to ask if you made X amount of sales this month. The rent payment will be due on the date that he states. So you're going to have to pay it anyway. So you want to make sure you have enough gross profit to cover it. So basically fixed cost minus divided by your unit sales minus your unit cost. So to put some numbers in to highlight this, let's say if your fixed cost is $200. So that's your monthly overhead. Let's say your sales is 10, just like in our last example. We have a cost of $5. That's going to give us a gross profit of 5. You take the 200 divided by 5. You're going to get a break-even point of 40. And what this means is that you're going to have to sell 40 units to cover that fixed cost. And think about that. Your gross profit was 5. 5 times 40, that'll give you 200. So to not be profitable or not lose money, to just have a break even, just meaning that you make $0 or have a profit of 0, you have to sell 40 units. So these are, powerful metrics. What you can do, start off with a spreadsheet. There's some software that you can use to, once if it's that time to scale and you want to pretty much take away the manual part of like tracking this stuff. You can use software, but just getting started, you can use something that's simple as Google Sheets or Excel to get started. So just understand that these things will impact your financial statements, your balance sheet on the left and your income statement on the right. So the metrics that we learned about today, they're going to give you a little more hands-on, a little more leverage when it comes to running your business. And the most important thing is going to give you that insight and awareness, because once you know, or you are, cognizant of what's going on in your business, now you have the power to change it. So just like how Peter Drucker said, the father of management, if you want to manage something, you have to measure it first. Okay, and that goes for everything. So if you're not measuring something, it's going to be hard to manage it because you don't know where you stand. So I want you guys to take these metrics, go ahead and implement them in your startup or your small business. And if you have any questions, just reach out to me, and much success with your company. Bye-bye.